I got a big question for you. What is your business worth? A lot of people want to know. Guess what? Stay with us. We're going to tell you how to figure it out. Hi, I'm Dave Nabity from Nabity Business Advisors. Welcome to Nabity on Business. And today we've got a really great guest that we're going to talk about a subject that I hear all the time, questions all the time. What is my business worth? I've got my buddy Greg Harr here, who's a partner with O'Donnell Fesnick, which is a full-service CPA firm, tax planning, tax preparation, business valuation support, and they do litigation and succession planning. All right, so Greg, I got to ask you, where do you start when you're starting to look at what a business might be worth? Where do you start?
Let's back up the bus a little bit. First off, the baby boomers there's been a supposed transition of business ownerships for the last 10 years, maybe even longer, maybe 15, maybe 20. But the owners in place, as they get older, haven't done any planning. They don't have any hobbies. Their life revolves totally around their business. Their business is their hobby. They don't know what to do themselves in the next stage of life. So consequently, they're holding on to businesses a lot longer than they should have until there's a life event. And that life event could be a heart attack, could be a stroke.
Cancer scare?
Any kind of health issues.
Broken hip?
Yes. And then they try to sell the business, and because they haven't done proper planning, that business is going to sell for a lot less than what they could have if they've done proper planning.
Especially if they could stick around for a few years and help with the transition of the company.
Correct. Or else as far as help their family, as far as get up to the stage where they could take over and get them in the same space.
So, one of the things I see are business owners that get in there and they basically feel like they're the only ones that has the wisdom and the smarts to be able to run and operate the business, and they can't count on anybody else. So they got to come in every day and they've got to run this place or this place is going to crash, and they're 75 years old or older.
Well, a lot of those parents are maybe domineering parents. Domineering parents, strong personalities. And they don't let the kids try and let them take the reins, make mistakes, because the best way to learn is by making mistakes. But the parents don't let them do that. So consequently...
The scary part is the only mentor for the kids has been mom and dad, and the kids aren't prepared.
No.
That's where I think that you've got to get outside consultants in that can put the kids through a business competence boot camp and really teach them leadership development, because they can't expect to get that from mom and dad because they probably haven't done a very good job of it.
Right.
But whether you're selling to an outsider or whether you're selling to your children, if you're trying to come up with an idea of what a business is worth, where do you start?
Well, usually what the standard for business valuation, if the business has been around for more than 5 years, I'll get 5 years worth of tax returns or financial statements. So it's normally 5 years of tax returns. If it's been around for 3 or 4 or 2, you get as many tax returns as you can. And you get an understanding of that business. If it's 2 years, was this first year an inception year? Are they only business for 6 months? You've got to talk to the people that run the business as to find out what is going on. What kind of business are they in? Yesterday, as far as I was testifying in a court case for a medical provider, and the other valuator did not do a management interview. And this business was 100% revolved around this lady that was the provider. If you don't find out what is going on with that business, you can't even start as to what you've got to determine what approaches and what's going to be the best way to determine the value of that entity.
Okay, let me ask you a couple of things. One of the things you hear people talk a lot is the first thing you want to establish is earnings before interest, taxes, depreciation, and amortization, EBITDA. What does that mean? What does EBITDA mean to a business owner?
Well, EBITDA is used quite frequently, but you can play games with EBITDA. What you really want is a net cash flow from the business tax affected. So I usually take 5 years worth of tax returns, and then I spread those out. And then I have a service that's called BizMiner against its peers, hundreds, in some cases thousands of companies of similar size and industry, so I can compare that company to the peers to see if there's any anomalies. I'm running the White's Bentley through the business. I got my golf membership through there. I've got my cabin on that thing. I got my condo in Colorado as far as running through the business. You find out about that stuff, so you have to normalize those numbers. Once you get it normalized, and you also have depreciation.
So basically you're adding back to cash flow all these unusual items.
Right. Well, in some cases, as far as with regards to depreciation, you can take and write off that piece of equipment as far as the year of acquisition, even though that equipment's going to last 5 or 7 years. So you have to normalize it for depreciation.
Well, on paper, it might be worth nothing at the end of 12 months. And if you went to sell it, it might actually be worth $40,000, $50,000.
Correct. So you normalize that. Once I have a normalized cash flow, I tax affect it for state and federal income taxes.
Because you have to pay taxes no matter what. Whoever owns it's going to have to pay the tax.
Whoever the buyer is going to have to pay taxes. So you need to know what that number is. Once you have that cash flow, net earnings after taxes, then you determine, well, how much depreciation, if it's been normalized. It's not a paper thing. So it's a paper entry.
It's a real reduction in the value of assets from one year to the next.
So you add back that normalized depreciation. You subtract it for the amount of acquisition of equipment that you've got, okay? And let's say, for example, and then you have to reduce it for the change in working capital during the year. Then you come down to a net cash flow that's available. Then you take the average of 5 years, and I like using 5 years simply because there's going to be peaks and valleys.
Yeah.
And you come down.
The only reason you wouldn't do that is if the company's on a growth spurt, and the type of business they're doing at year 5 is not only way bigger, but it's dependable compared to where they were when they were started.
And that's when you're going to find out when you talk to management what's going on. Okay, so the last 2 years is kind of indicative of what so instead of taking the average for 5, you may take the average for 2, or maybe even the average for the last year and use that because we're just going up.
Well, a part of that too is what type of sales they're getting, right? I mean, for example, if you have somebody that signs up for a contract to pay you X amount each year, you have a real high probability that cash flow is going to continue to come in down the road.
Right.
If you have one-off sales with somebody that you might not see again for another 5 years, that's a different animal, right? So talk a minute about when a buyer is looking at all this, they're trying to figure out how quickly they're going to get their investment back from the earnings of the company.
So when a buyer comes in, they're going to do their due diligence, and they're going to have a list of items that we want. And as far as when you talk about contracts, we want to see those contracts. How long are the contracts are? Can they get out of the contracts early? What's driving the bus for this revenue stream? Is it going to continue?
And if it's ongoing and dependable, it brings a higher multiple.
Right. Well, it's not so much, but you know that your cash flow is going to be going into the future. If they can get out of the contract, how long have they been really a customer of yours? If there's a long history and they get out of the contract, more than likely they won't. It just depends. You've got to find all that out during your due diligence.
Yeah. But as a buyer, if I'm going to pay you $1 for your company, my financial people are trying to conclude in their own minds, how long is it going to take me to get my dollar back before I start earning profit on my investment, right? So that's a multiple of EBITDA or the cash flow number. And so if it's a multiple of 3 versus a multiple of 8, what do you see as the deciding factors of why you'd get a big multiple versus a short one?
So you're talking about capitalization rate. You're talking about EBITDA. There again, I don't like EBITDA.
Well, cash flow will give me my dollar back.
Cash flow is giving your number back, but you've got to figure out what's my cap rate. So normally you determine your cap rate based upon what is called a weighted average cost of capital. What kind of collateral can I borrow on? And if I can borrow the money at 8.5%, what's the tax rate on that money? And so it's going to be a combination of what I can borrow and my skin in the game, your equity. And the equity rate of return is based upon the business itself, what kind of industry it is in. It's based upon a 20-year tax-free the interest rate treasuries, plus what the stock market has done since 1928. It's based upon the EBITDA or the beta of that industry, and it's based upon that specific company. Is there problems within that company? Do they have a thin management? Do they pay out dividends? What kind of industry?
Okay,
is it litigious?
When you talk about a cap rate, aren't you saying I can either put my dollar into your business and I'll earn X.
Right.
But if I put my dollar over here, I know I can earn Y.
Right. But so you're taking a look as far as basically because of the risk of the business, you may be as far as a cap rate of, depends upon how stable it is, it may be anywhere from a cap rate of 10% to the low 20s, depends upon the risk. I mean, you can go out and put your money in treasuries and make 5%, but as far as you're going to get, the lower the cap rate, the higher the value, okay?
Right.
All right? So the more risk, the lower the value. And when I get done doing evaluation, how I determine if I've got a good number, if I had to go out and borrow that money at 8.5%, how long would it take me to pay back that money? And it's usually anywhere from 7 to 10 years.
That's a good way of putting it. Just assume that you're going to borrow the money.
Yeah.
And with the cash flow that's coming out of the company, how long is it going to take for the loan to get back? Because you don't make any money until the loan's paid off.
Right.
So if I'm going to pay you 8 times your cash flow, I'm going to want to get my loan paid off in 4 or 5 years with the cash flow, right?
It's usually about 5 or 6 times as far as the cash flow with everything else. And usually as far as, that's my sanity check if I'm in the ballpark. If it doesn't pay for itself within 7 or 10 years, I know I've done something wrong and I got to go back and take a look at it.
Yeah, but 7 or 10 years, that sounds like a long time, right?
Yeah, but you're going to get all your money back in 7 years, and then from you've got, okay, I'm 71 years old.
You better be young.
I'm 71 years old. I'm not going to go out and buy a business because I may not be around. Okay,
you might become room temperature.
I might be. I might be colder
Just
than that.
Just don't do it right now.
I might be colder than that.
But yeah, no, you won't. But
no.
Okay, so let's go back to mom and dad and the kids.
Yeah.
Mom and dad want cash flow in retirement.
Yeah.
They're trying to come up with a valuation that's fair. By the way, don't let me forget to talk about estate planning here for a second. But they want evaluations that's fair, but they don't want to overburden the kids. And at the end of the day, they're going to sell the business on the installment plan to the kids. What do you have to say to mom and dad with regard to that? You go first, and then I'm going to give you my 2 cents.
Well, there's, it's part of what you're talking about, estate planning. It's planning. I just did within the last couple of years, a large concrete company here in town. And so the father is staying on board as a consultant, so he's getting paid as far as compensation. So that gets deductible, okay?
Yeah, it's an expense to the company.
It's an expense to a company, but it's cash flow to him. He gifted half of that business to his son, and his son is paying back the rest of the half in the way of a note with the interest rate of being the applicable federal rate, the lowest rate you can charge. So
that's about 4% now, right?
Right. And so what you're trying to do is work out a plan which works out for the parents and for the kid so he can afford to go forward. So you want a legacy. You want your name to keep on going. So you figure out a plan that will keep the legacy in place, get you enough for retirement, at the same point in time, get that kid down the road.
Yeah. Well, and part of it, you got to tax adjust all these decisions.
Oh,
right?
yeah.
And one of the things we like to do is get all the sources of income that the parents have, Social Security, investments from real estate, rentals, and stocks, bonds, whatever. Get an idea what kind of cash flow's coming in, and then build in, like you say, they gifted, but he's getting a salary, so it's kind of like they offset
right.
each other, right? And then note payments. We've asked this question many times. Can you live off of this? At the end of the day, when we get this transaction done, do you have the personal cash flow to be able to live decently? And then we also have to ask the question, will the company have enough cash flow and working capital to be able to continue to operate well and grow?
Right.
And you got to do all that spreadsheeting to figure it all out. But there's a lot of play in a family valuation versus if you were going to take the business to market, wouldn't you say?
Oh, yeah, definitely. Depends upon as far as what the parents actually want. Do they want, when you get to the third generation of a business, when you're going into the third generation, the fourth generation, a lot of problems, you could tell by as far as a lot of these Italian steakhouses, the fourth generation doesn't want to work that hard. What they call the entitlement generation. They just want the money.
Yeah.
So you're going to be going to a VC group. There's been a VC group that's bought a couple of nice restaurants here in town, and and I helped out with those things, and they're doing well. So let's back up the bus a little bit more to going back what you're saying about mom and dad. When you're planning for the parents, you want to make sure you got a 3 or 4 leg stool. You've got your retirement funds, your IRAs, your 401ks, you got your Social Security, you got your other investments, and you got whether the business are coming. And you want to make sure you got a 3 or 4 leg stool that can take care of that and go into the future so that they don't have to worry. But first off, you have to figure out what the lifestyle is of mom and dad, if they got any debt, how big they live, and where they're comfortable.
They're traveling the world every quarter. You got to, if that's their thing, you got to make sure they got the cash flow to do it.
Right. And I guess the whole thing is what is important to you? What is important to you? How much do you want to leave a legacy, or do you want just to, give some money to your kids and go off and be a fat cat?
Let me talk to you about a brain buster. Let's say you got a company that's worth $100 million or more, and the parents are desperately trying to figure out how to transfer it to the kids. And you're looking at every option. Gifting, you can gift, you can sell the stock to an intentionally defective trust, and that's too complicated for us to cover today. But the bottom line is the note can get paid off with money that would otherwise go to taxes and wipe an asset off the balance sheet. But you still got to come back to valuation. And in an estate planning scenario where you want to pay the least amount of tax, you're begging for a valuation that's as low as possible because you want to try to do all the gifting and shifting and selling and everything at the lowest value. And the risk, talk about the risk. If you really overdo your discounts of the value of the company, what kind of audit risk do you have after you've done all your planning and the stock is in the next generation and all that? And then the pencil-necked geek with the thick glasses shows up and he says, I'm from the IRS. What sort of, how do you deal with that?
So when you're gifting to family members, in the form of a family limited partnership, a flip, this typical generation is what I'll do. Basically, the IRS likes to see 35%, a discount no higher than 35%. So I was involved.
But the starting point is also, there's a lot of fudge with that, right?
Well, I was involved in a valuation, and we're talking a big one. I mean, large, north of $100 million, that we had a discount of an excess of 50%, and it passed mustard.
Are you serious?
And we got a letter back.
You got audited?
No, we got a letter back.
Oh my gosh!
So it just depends upon if you do your homework. But you got. I've been doing this for over 25 years. That's the first one that I ever had that was
that aggressive.
That was that aggressive. Normally, 40%, you can get by with 40%, 40 in the low 40s.
But it's a combination of two things. You have a lack of marketability discount,
and you got a lack of control
discounts. And so I don't know if do we want to get into voting and non-voting and discounting the voting?
Well, as far as voting and non-voting, there is no, in all the studies that have been made, there is no extra discount for that. Okay.
Really?
Yeah. But
now I hear about it, the non-voting discount all the time.
Yeah, but you're not going to get away with it.
How do you get to a 40% discount then?
Well, it's the controlling and lack of marketability.
Those two.
Yeah.
Okay.
But you've got another.
Not the minority.
But you've got another one that comes into play in some cases. Key man discount. The businesses revolve around dad, and if dad's gone because he's got all these relationships,
there could be a big loss in revenue.
Yeah. You got to do your homework.
Okay. I had a company that bought a lot of rolling stock that they used to support the business. Buses, trucks, you name it. And on paper, if you were to look at cash flow numbers and do a multiple of 5 or something like that, it would be worth, let's say, $1. But because of all the assets they have to buy from one year to the next to support the earnings of the business, if you took all those assets to market, you forgot what you were doing for tax depreciation, and you took them all to market, the company was worth $2 or $3 because the assets were so big. But those assets only produced a 3%, 4% rate of return for the cash flow. And so nobody would buy the company for $3 because the return on investment is so low. But it's a family-run business. It's been around for a long time, and they want to move it from one generation to next. And we went to a different firm than you guys to do a valuation on that thing, and we got like a 30% discount off the $3, but we got nowhere close to the $1. And it was nerve-wracking because if you took a loan out and you bought the company for the asset value, it'd take you 30 years to pay it off.
Yeah.
So what do you do in a situation like that? It makes if you liquidate it, you would get $3. But because of the cash flow the thing's kicking off over a 5-year period of time, it's worth $1. You got did I stump the band on that one?
No, as far as I know the case you're talking about, because we've talked about that one before. But, I mean, there's 3 ways to value a company. It's called the income approach, the market approach, and the asset approach. And you're talking about the asset approach. You're valuing the vehicles at fair market value to come down to what value. But evidently,
you'd never sell those assets if you're transferring it to children.
No.
You never do it.
But the whole thing is what they're doing is they're having a livelihood off of this thing, and they're making good money.
And they like the business.
They like the business. Eventually, as far as those kids are going to get tired of it, and they'll probably sell it to a VC group, a venture capital group. That's probably what's going to happen. Somebody that wants to do the synergies and take a lot of these companies. Increase
the earnings by pulling them all together.
Yeah. That's eventually what's going to happen at that time.
Okay. This is going to put you on the spot, but let's say you have somebody out there that has a business they think is worth $10 or $20 million, just at that level, and they're going to hire somebody to get a valuation. What kind of costs would they have to get an independent appraisal from a smart guy like you?
Well, I wouldn't call myself smart, but anyway.
Educated.
So really what it comes down, it's on an hourly basis, okay? People try to nail you down to a fixed cost.
Okay.
But it just depends upon, if you do it right, it's going to take you some time to figure out what you've got.
Well, I mean, you're not going to have 40 hours in this thing. You're probably going to have 100
No, it won't.
By the time you're done.
It depends upon the company and the size and the complexity. Okay. I can give you a range as to what costs, and that's usually what I do, is I give them what kind of they want. They want a calculation engagement? Do they want, as far as a summary report, do they want a detailed report? And the higher up the food chain it goes, the more cost because they got more work involved.
Yeah. Yeah.
It just depends.
What we find is when we do valuations, we're doing what you're talking about, but it's a simple thing between family members where you don't have big estate planning things on the table. Otherwise, we come to guys like you to get that independent appraisal that would help us fight against the IRS if we're trying to do gifting and shifting and transferring. That becomes really, really important. But what I was going to say is it's amazing the hours you end up spending on this stuff because you're spreadsheeting your brains out, you're forecasting, you're looking at all the financials and trying to figure out the cash flows. And you end up concentrating so much, and then you walk away from it. Okay, now what did I forget there? Is there something else I need to put in? And then you come back and you work on it, and it's very time-consuming to try to do the right thing for a client.
Well, I guess the whole thing, it's a good thing that the bill that came in effect as of January 1st of 18 got passed.
Oh, talk about that.
And, you got a lot of farmers out there that are cash poor and land rich. And at that point in time, if they didn't get that passed, it would have gone back down to $7 million.
Oh, the estate tax exemption.
The estate tax exemption. And you
We're
get a
gonna
husband
cap
and wife.
right now at about
15
per person.
per person.
So
So you're talking
30
about
million.
30 million. But it depends upon how that land is titled. You got some farmers that are headstrong that they haven't done any planning. It's all in their name versus a joint basis. And at $10,000 to $12,000 an acre, it doesn't take you much to get to 15 million.
Oh, sure.
So they need to do some planning.
Do you like to see, I mean, joint is one thing. Do you like to see those assets held in limited liability companies as opposed to being owned outright between mom and dad?
Well, if they want to do any planning, you do form what is an LLP with the kids, where the parents keep control. The kids can't do anything, but you've taken that 35% discount and you passed on some of the next generation. But the parents, nothing happens without the parents.
Yeah.
Yeah. So the parents still keep control and they can take a management fee and still live the way to do. It comes down, there's a lot of business owners that are great planners and some that aren't. And it really comes down to, you got to plan. If you don't plan, you're planning to fail.
Well, let's finish up on the soft issues for a minute.
Are there any soft issues?
Yeah. When you work on putting together the numbers for the valuation, you still have to ask yourself the question, do you have the people in the right seats to run and operate this thing when you're gone?
Right.
And just because they're blood doesn't mean they should own stock.
Right.
And one of the things we try to do is we've got a questionnaire that we work with the parents, and we basically have the parents analyze themselves as far as what kind of leaders they've been.
Right.
Then we have the parents analyze the children to see really how they feel about the child's ability to really step up and be in leadership of the company. Then we have the management team analyze the children. And then we get to the children. And we ask them a lot of questions to see what's up here and what's up here. And before we even build a succession plan, we want to gather all that so we see what we're dealing with. Sometimes I see parents that have big blinders on.
Yeah.
And they love the kid and they hope and hope and hope the kid will do a good job, but the management team doesn't think they do. They know that their kid's got some real deficiencies in their leadership and their skill sets, and the kids aren't very authentic and self-aware of what they're good at and what they're not good at, and you see a big problem coming down the road. And I don't know if you see that, but we try to figure all that out before we actually look at getting the valuation and try to build a transition plan.
Yeah, no, I see that quite a bit. Parents want to make sure as far as all the kids are treated equally.
Oh, for sure.
Okay, so what you're trying to do is develop a plan where the kid that does not have the acumen to really run the business, but the parents have real estate. So instead of giving them as far as an ownership interest, you give them the real estate. You form a family limited partnership as far as with the real estate, and they got the majorities. There's a way to do it, but like you said, you got to do your homework to figure out what's going to be the best plan.
If you have a son or daughter that's really capable in running and operating the business, and they have siblings that are not active at all, or if they are active, they're easily replaceable, but you want them to have equity all the same, you're setting up a nightmare.
Oh, you are.
Just an absolute nightmare.
It's really sad, but when the parents die and there's a lot of money,
oh my God.
The greed.
Oh.
So you want to make sure that's all in place.
Yep.
So basically, I just had a large construction company in here with the son is running it, and he's really doing a bang-up job. But then he's got some relatives, he's got some sisters and brothers involved that don't have that capability, aren't even in the business. But the parents had real estate.
Yeah.
So we're able to carve that off as far as for the kids. And the son's run the construction company, doing quite well.
Well, you can even, if you have a deficiency in assets, you can get life insurance
Yeah.
on mom and dad,
Right.
and make sure that the kids get cash,
Right.
instead of forcing the closely held stock to be in the hands of people that aren't active in the business.
And then you can lose your management.
Yeah. Oh, there's another key point too, because if Junior is 5 years away from really being a CEO, you've got to make sure you hang on to your management team until Junior's ready.
And you either give them that as far as a, I can't think of the name of right now, but you give them a stock interest
Phantom stock.
Phantom stock. That's
Yeah.
it. You give them phantom stock, or you give them a bonus plan, or you give them 5% interest.
Deferred comp even.
Yeah.
Yeah.
So you keep them.
Yeah.
You've got to keep them.
We build something called a management incentive and retention plan, and it's designed to get contributions to a fund for each year of service. It's got a vesting schedule, and if they stay until retirement to give junior time, then they get a big bonus at the end. So anyway, those are some of the things hopefully that you will find valuable when it comes to trying to figure out how to value a company. If you have any questions, I just need you to call my office, 402-391-0222, or go to nabity.com. And if you need Greg, I'll make sure that I get you in touch and see if he can't help your company as well. Thanks so much for watching and listening to Nabity on Business.